All right, so tonight we're going to cover a pretty hotly debated topic, kind of a lot of news coming out of the real estate market. I was planning on doing the investor ban, which we will get into, but first I want to dive into this $200 billion bond to allegedly or hopefully help with interest rates for, first-time buyers, people on the fence, or, just maybe freeing up some equity for some folks so they have the opportunity to refi, which hasn't been so hot the last couple of years just with rates. So yeah, like I said, today we got my buddy John on, and we're going to go over this and break it down as in depth as we possibly can, and determine, is this something that could fix the housing market? Is it a band-aid? Is it a long-term fix, or just a short-term fix to maybe reignite the housing market? Because it has been a little kind of oddly flat. If you watch some of my other videos, it's been kind of goes up a little bit, then kind of comes back down. But overall, for the last 2 years, I think we've been kind of in a like a plateau, so to speak. So, maybe this will give us some insight on into where the market's going, or if it's just going to be more of the same. So before we dive in, John, you want to tell us a little bit about yourself again, man? I know you've been on a
Yeah,
few times, but for folks that haven't,
yeah, for sure.
first-time viewers and whatnot.
So, mortgage advisor, been in the industry for about 25 years. So, I've pretty much seen a lot of stuff. I was there when the market crashed in 2008, made it through that, and here we are today with these different types of challenges for buyers. But yeah, we I've been in the business 25 years, man, and just always learning, always trying to educate people out there on what's really happening in the market, and I'm just glad to be here.
Yeah, and there's been no shortage of learning in the industry for the last couple of years. It feels like every 3 months we're kind of recorrecting or relearning, or
Yeah.
just kind of trying to re-engage with what's going on. So to start, we'll start with this. Um, Normally we'd say tweet, but I think it's a Truth Social. Uh, President, I don't know what you call this, Truth this out the other day.
Yeah.
Basically, his plan to fix the housing market, or help, with the struggling housing market, is to free up this $200 billion and put it towards buying back these mortgage bonds, with the hope that it'll drive down mortgage rates, monthly payments, and make the cost of owning a home just more affordable. It's one of the many steps that he's taking, and just to make the American dream palatable again. So let me stop sharing this. First thoughts. We'll dive in and break this down and dissect it. But first thoughts, when you saw this, what was your initial reaction?
So initially, it's good, right? It sounds like it's a good um, thing that's going to help bring rates down. And I will tell you, initially, when it was announced, rates got really good for pretty much overnight. And what I mean by that is, I'll just give you a quick example. I We were under 6% for the first time in quite a while on a 30-year fixed conventional.
Mhm.
I had a client that I locked on Friday at 5.99 with no points. He's doing a refinance. We were talking just a couple of months ago. It was a 1 point cost for that same rate. So I had talked to him the day before and gave him a rate of 6.125, and we hadn't locked or anything. But as soon as this was announced, it dropped about an eighth percent or a little bit more overnight. So we were able to lock him in at 5.99 for the first time with no points. So initially, I think it was a really good thing. The 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 big thing about the 200 billion is I don't know if that's going to be enough to really bring the market down long term. I think it's a great thing to do, but I don't think it's going to really have a huge impact because if you go back to the COVID years, and I was looking for this, but I couldn't find it. The government was infusing so much money, a lot more money than this, into the bond market at that time. I just
Mhm.
don't remember the exact numbers.
It
And
was, I want to say it was about 1.2 trillion. It was one or 1.2.
okay, so see, I'm glad you found it because I couldn't find it. And when you talk about 200 billion to 1.2 trillion, that's a huge difference. So 200 billion will help, but at the same time, you have to look at all the other economic factors, the jobs report, inflation, those things that we're looking at on a regular basis anyway. As those things fluctuate, this may help stabilize us a little bit, but I don't see that it's going to really make a huge impact.
Okay, fair enough. And that's those were my initial thoughts on it too. Is just okay, 200 billion. That's a ton of money.
A lot of money.
It's a lot. It's it's nothing to sneeze at for sure. But knowing during COVID, they infused it was about one or 1.2 trillion
Yep.
to kind of help keep things afloat, keep positivity going. And we saw what that did to the market. Now we're talking about an amount that's, about 20% of that. We're not really in the same situation. We're not as worried about the economy collapsing, housing collapsing. I think during that time there was just so much uncertainty. Because I remember that it was March 2020 when, basically the rug got pulled out from under us. I think we all had escrows going at that time where,
Yep.
they're canceling left and right. Investors were pulling out left and right. The Zillows, the Redfins, OfferUp at the time. I think they're still around. They left a lot of sellers high and dry.
Mm-hmm.
I remember they were pulling out like crazy, so the government had to do something at that time. I got another article here, and we could just kind of go through this by piece. So I read through a ton. They all kind of say the same thing. So I, tried to find the most unbiased, and they all basically refer to alternate press or AP. Trump orders 200 billion mortgage bond purchase to boost housing affordability. Big question: where's that 200 billion coming from? So for the bond purchases, they'd be drawn from Fannie Mae and Freddie Mac, the two government-backed mortgage firms that remain under federal conservatorship. I believe during his first term, there was talk about those being privatized, right?
And they were still talking about it now.
Okay.
Yeah.
So, I mean, let's go into that a little bit. Is that they go privatized? They're not government owned anymore, right?
Correct. So just to put a little bit of background on it, the reason the government took them over was during during the 2008 crash. The government had to step in and take conservatorship of them because otherwise they could have potentially folded. So now, I mean, this may sound a little weird, but Fannie Mae and Freddie Mac has been basically a piggy bank for the government because Fannie Mae and Freddie Mac is one of the most, what I guess you could say, wealthiest companies out there. And a lot of that money, Fannie Mae, Freddie Mac aren't making that. It's directly going to the government. So this $200 billion that they're talking about pulling, they're actually talking about pulling it from the Fannie Freddie surplus. So, which is good, I mean, to use it. But on the flip side, here's one thing that you need to kind of take into consideration. If they pull that money, and I'm just saying hypothetically, if there is a crash, something happens in the mortgage space, Fannie will not and Freddie will not have those $200 billion to help with some of the negative stuff that could happen from a market that's not doing well, right? Now, I'm not saying that's going to happen. I'm just saying they're pulling from Fannie and Freddie to you, or that's what they want to do. Pull from their piggy bank, so to speak, and infuse it into the market. I'm not saying it's good or bad. I just think that's just something you need to be aware of.
So with that piggy bank, that $200 billion piggy bank,
Right.
what would that normally go towards? Why would they stockpile that much cash? What would they normally use that money for? Like in a reserve sense?
So in a reserve sense, it's let's say that there is a market collapse. That money could be used for that. And I don't want to call it mortgage insurance because it's not, but something to help the market, I guess, recover from something bad that's happening. So that's what it could be used for.
Okay, and another stat I found, and I wasn't doing real estate in 2008 during the crash. I was in college. They originally got the market back on the right track by using, I think it was around 1 or 1.2. I have my 2020 and 2008 numbers mixed up. It was around a trillion
Mm-hmm.
to pump back into the market that way to bring rates down to help with that recovery period. So that 200 billion, that's essentially what that would be. It's more of like a relief fund to jumpstart the market.
And something that could help in an economic downturn.
Okay.
Something that's there. Like almost, I don't want to, they're different, but almost equivalent to FHA. FHA has their mortgage insurance fund, which is way overfunded right now. that in case something happens, FHA and HUD has those reserves to be able to help with those loans that possibly would go to short sale or foreclosure. But
Some sort
again,
of delinquency.
it's money that's there just in case.
Okay. So we'll go back to this. Sure. Okay. So Trump said the two entities have 200 billion cash that can be used to buy down bonds. And of course, credited his decision during his first term not to sell Fannie and Freddie, saying it was against the advice of experts. So how is this plan expected to lower rates? I think that's the big question. How would this lower rates? Just pumping 200 billion back into it. Where do the rates play in with that 200 billion, and how does it buy it down hypothetically?
So there's we have there's mortgage-backed securities, and then you have the bond market, right? When there's more money in the bond market, you tend to see rates go down. So if they're pumping money into the bond market, you're going to see rates go down. If they're so let's say the stock market is not doing good, and a lot of people put money into bonds, that helps rates. Now, if there's some sort of negative information out there in the stock market and people start pulling money out of bonds, that's when rates tend to go up. You see, so they're talking about putting money into the bond market, which will in turn lower mortgage rates. But again, nobody knows how much and for how long.
Okay. So I know I mean, doing this for so long, we know we're like in a little bit of the slower season right now. Going from like November to, let's say, February. Do you think this is kind of a knee jerk reaction, or maybe not so necessary right now? Maybe like see how things shake out in spring before doing it, or do you think this is the right time to test this out?
I think since Trump has come into office, even before he came into office, his main goal was to lower interest rates and get the market moving and help people buy homes. Um,
Hmm.
I don't think it's bad timing. Me personally, I don't think it's bad timing. I think it's if it does happen and it helps, I think that's good overall anyway, right? But one of the things to consider, if things happen too fast, you got to look at what if a lot of people that are sitting on the fence that haven't bought up have thought about buying for the last couple of years but haven't, and say, okay, now rates are 5.75 6%. Does it make sense for me to buy? What happens if a million people jump in but we don't really have much more inventory for that, right?
Hmm.
I mean, you're a realtor, you know exactly what's going to happen. There's
Yeah.
going to be bidding wars, right? So I just think if you do it too fast without the inventory, it could have still a negative effect on housing prices.
Okay,
Not bad,
that's a good
not for
point.
the seller, but for the
What was
buyer.
that?
Not for the seller, but for the
Oh,
buyer.
yeah, and that's a good point. I completely agree with that. Because the reason we're here, rates or not rates, but pricing is so high. I know we're talking a little more about rates and that side of it, but the reason pricing is so high is, rates were artificially low for
Right.
a long time, but there was such a lack of inventory, because we didn't have that construction from, well, like '09 to, I
Yep.
mean, really like probably 2022 to replenish,
Right.
the adults coming of age. So I kind of identified it in 2018, 2019. This is pre-COVID. I was like, wow, we really do have a shortage of inventory.
Yep.
Because everyone in 2018, 2019, we thought we were going to see a crash. I know a lot of realtors and investors personally that they were pulling out of the market at that time because the signs were indicating that we were going in that direction. The thing that saved us was there was no inventory. you
Yeah.
know, we're a little bit better off now, just because they streamlined in California anyways. They streamlined the process for the new bills. That's why you see them popping up, in
Yeah.
such massive quantities now. So I still don't think I think what we're seeing now too, with the market even being as tight and as rough and unaffordable, and it's not going anywhere. It's 100% because of lack of inventory.
Yeah, and that's keeping it moving. I'll give you an example. Some areas homes are not selling, they're sitting a little bit longer. I
Hmm.
was talking to one of my buddies today. They had an open house on a property in Hawthorne 2 weekends ago, not this weekend, the weekend before. And it was a flip property. They had over 120 families come through that house,
Wow.
and and got several offers. The highest offer was $20,000 over asking. So that doesn't happen when you have a healthy inventory, right?
Yeah.
So I mean, if you have plenty of inventory, that doesn't happen. But yeah, this was literally just last weekend, a week
Okay.
and a half.
And to kind of offer my end on that is, you said it's a flipped property, right?
Yes.
Okay. So houses that are, priced even remotely right and done up like that, where buyer comes in and they don't have to do anything, that they're almost always willing to pay a little extra for that.
Right. They're
Um,
going to pay a
y-
premium.
so we are seeing days on market rise, but with homes like that, they are still going quick.
Yeah.
They may sit for a week longer than they would have, a year or two ago. But those turnkey style properties are those ones where, it's a lot more modern, especially Hawthorne, because I think average
Yeah.
age for the houses out there is what, 60s, 70s.
Yeah. It's older, a lot older.
Yeah. So, when you look at the neighbor's house and, it's still got 70s aesthetic, and you go
Yeah.
look and it's more modern. Yeah, that's going to go with a lot of attention really quick.
Right. Right. So I mean that's something that I think in the overall scheme of things, the big thing that we still need realistically, I mean, everybody wants to bring down, make housing affordable, which I think is great. But the reality is, I think for that to happen, we do need more inventory for that to happen. Yeah,
Yeah,
because
that, I mean, I have my theories on that,
Mhm.
and I mean, really, what we need is inventory to, rise so that the prices come down. And then, we'll go into that segment, after
Okay.
we get through this. Um, I think his push with the ban on the investors, or limiting what investors can do, is supposed to help with that. But when we look at it, you'll see that most investors, quote unquote, are mom and pop that own three or four doors.
Yeah.
It's not a, it was a BlackRock or Home
Right.
Partners, or any of those. I mean, they do own quite a bit, and they were a big buyer during those COVID years. But prior to that, they were, I mean, it was minimal. It was 2 to 3% of the market.
Right. I completely agree with that.
So, the hope is that it drives mortgage rates down, monthly payments down, and makes the cost of owning more affordable. I think one of the ricochet effects of this is, a lot of folks that bought like in those 7 to 7.5% rates, now they have an opportunity to realistically refi into something that makes sense. Going
Right.
from 7% to 6.25. I mean, because really, to make it worth it to refi on the lending side, you kind of advise around 1%, right? 1% or more.
Yeah, in most cases, it could make sense for somebody less than that, but yes, in most cases.
Okay. So yeah, going from 7.5 to 6%, yeah, that totally makes sense. One of the big things that I'm seeing, and I know you're seeing a lot too, is auto loans are high. Credit card debt's
Yeah.
at an all-time high, and student loans just became due again. Well, I guess it's been about 8 months now. So people's debts are a lot higher than they were, 3, 4 years ago. So, housing regulators response soon after the announcement. FHFA, Bill Pulte, the regulator, he was on it pretty quickly, right? I think he said, "Done deal, let's go."
Yeah. Yeah. Yeah, I mean, they're ready to make it happen. You
Yeah,
know.
yeah. I know the Fed's dragging their feet on things, which they have their reasons for, but it seems like everybody else around the housing market, housing industry, higher ups, they all want to see those lower rates. So next question was, why are mortgage rates still high in the U.S.? The Federal Reserve has traditionally been the largest buyer of mortgage-backed securities. During COVID-19, it purchased hundreds of billions of dollars worth of such assets. I think, like I was saying before, I've seen about $1 trillion worth.
Right.
While increased purchases of mortgage-backed securities typically reduce mortgage rates, the relationship is indirect, as the Fed does not set home loan rates. So, despite several cuts to the Fed's benchmark interest rate last year and again in 2024, rates have stayed elevated. So they haven't been responding to rate drops, like from business to business, the way they were in the past, right?
What do you mean?
So in the past, when they drop rates, like when they had rates were at zero during Trump's
Oh,
first term, I was getting calls all the time like, "Oh, we heard rates
right.
are at zero, but mortgage rates were at that time, I think, like 4.5, 5%."
Dude, I remember when they announced that there was the 0% federal funds rate. we were getting bombarded with calls. I remember doing a video saying, and putting it out there, just saying rates are not 0%. That's what the banks borrow the money for from the government for. They're basically giving the money to the government. I mean to the banks so that they can lend it out at a lower cost. But so many people thought that we were 0%, and although that would be nice, that just wasn't the case.
Yeah, yeah, that would be nice. I don't see a world where that happens though.
Yeah,
I mean,
you
who
can't.
knows? I mean, things change all the time. And the last piece on this I wanted to end with was Trump did not specify who would execute the bond purchases, nor did he outline a timeline or operational framework. So with that, I know there's a lot of enthusiasm in the space
Yeah.
with this 200. What has to happen before this actually happens?
That's a good question. I don't think we know that yet. We don't know, or that I'm aware of yet, what it's really going to take for them to use those $200 billion and when they start putting it in the bond market. I can guarantee you that when it does happen, it's going to be big news. They're going to, because it was big news last week. So when it starts happening, we're going to see that it is big news, um, that they're doing that. But I don't think there's a timeline yet.
Okay, so right now it's just speculation. The rate drop on Friday was excitement to that speculation, right?
Exactly. Yep.
Okay. And then today I saw that rates did jump up a little bit, right?
About an eighth to a quarter, depending on the situation. They did. Yeah. The market opened, like I get notifications, and the market opened up negative and it finished even higher negative, more negative at the end of the day. So yeah, and that's what happens. I think, to me, this is a good point for people, because if somebody's looking to buy a home or refinance a home, it's always better be prepared for when these little blips come, because they happen. But when they happen, I saw a video the other day that somebody put something out saying, hey, if you're looking to refinance, and this was somebody else, they were saying you should take advantage, you should be ready to go, because sometimes these blips only happen for 18 to 24 hours. And if you're not at the right place at the right time, you can't take advantage of it. So I think it's a good indication, or a good reminder for people. Be ready. Talk to
Yeah.
your lender, talk to your real estate professional. Be ready, so when these blips do happen, you're ready to make a move right away. I mean, you don't, we like we said before, you can't time the market. You don't know when this is happening.
No, not at all. And like I stress on this channel a lot. Like a big part of what we do, why we are here, is the game plan. So like when you do see a blip like this, like you don't know how long it's going to last.
Right.
From experience, we saw this a lot during 2022 and 23, where rates would get favorable for like maybe a couple days at a time.
Yep.
You
That's
know,
true.
I have the feeling we're going back kind of into that market. It's not going to be a five and a quarter versus five and three quarters. I think it's going to be a 5.4 versus a 5.6, or what have you. Just kind of arbitrary numbers there.
Yeah.
But having that game plan and being ready to go, and just knowing like, okay, these are the numbers we're looking at. This is what we're working with. Even if you're not planning on buying or doing anything until summer or fall, it's never too soon to put
Right.
together that plan of action.
I mean, it's always better to be prepared than not prepared, right? I mean, and a lot of times, I think there's fear with people even just taking that first step, because they hear how high home price, excuse me, how high home prices are, or where rates are, and to put it in perspective, where we are in rates, we're about average of where rates have been historically. The difference is we're in a different time because homes are so much higher now.
Mhm.
When when I got into the business in 2000, at the end of 2000, beginning of 2001, rates were about 7.5 to 8% back then in 2000. So that, wait a minute, I'm sorry. Yeah, that's right. Yeah, 2000. I'm drawing a blank here, but yeah, that's where they were. They were about 7.5 to 8%. I bought my first house in 1992. Homes were our rate when we bought it was 6.5%, 6.5, 6.375. So when you look at rates where they are, the difference is the homes are a lot higher. From that, but
Yeah,
wages have also
absolutely.
come up.
Yeah, and I've been doing this a little over 10 years now, and I've always heard a healthy market is a 6% rate.
Yeah,
I don't know. It kind of seems like that's true because I feel like, when rates are low, you start to see those runaway property values. When rates are high, that's, kind of when you see property values coming down or people just getting priced out or waiting it out. Um, the market, like I said, it's been pretty flat. I think that's, if you're trying to buy something and then sell it 2 years later and hoping to make a ton,
yeah,
that's not really going to be the case. But you're still getting that equity or forced equity like we've talked about before. So with those 6% rates, it's really keeping that housing market in check. So I mean, imagine rates dropping to 4.9 right now across the board.
it would be a mess. It
Yeah,
would be great, but it would be a mess.
it'd be great for a little bit.
Yeah, yeah. I mean, not like if you go back to COVID, when you show up to an open house and there's 100 people outside waiting before it's even open. I mean, you could literally get back to those kind of times again.
Yeah, and I could absolutely see it going that way. Like you were talking about your buddy who did the open house on that flip with 100 families coming through. That's a lot. I mean, most of my open houses that I do, when it's a property like that, you're going to see a ton. But
Right.
if it's a just kind of standard home, 90s build with 2010s upgrades, you might see a handful of people. Maybe six
Yeah.
parties come through in a 4 hour period, and that's good. That's good traffic, and that's the way it should be. But when you have 100
Right.
people coming through, like that price is going to get driven up. For the
Oh
buyer,
yeah.
that's not great. For the seller, it's awesome.
Right. Yeah. It's
So
it's. I
with
mean,
with sorry, good.
no. Go ahead.
I was going to say, with this 200 billion going back in, what can we realistically see, or maybe even expect as far as rate drop? Like, is that a half percent? Is that a full percent? Is it a quarter?
So that's again that's the unknown. Nobody
Mm.
knows what exactly we could see because of all the other economic data that's out there, right? There's things that are still going to offset it or outweigh it. So it's really hard to say what kind of impact it will have until it happens. You can't say, oh, 200 billion is going to drop it a quarter percent. I just don't think you could predict that. But if it does go in there, I mean, if that money does get put in there, it is going to be better relative to what other economic data is going on, right? Again, the inflation, the unemployment reports, the that type of data.
So okay. With that said, hypothetically, that 200 billion goes in there with the intention of bringing rates down. We get a bad hypothetically, we get a bad jobs report. Inflation jumps up again. Could it go the other way?
It could. It still could. It because at the end of the day, I think the 200 billion is more of a. It could be a band-aid. Again, I'm not saying it's negative, it's good or bad. I'm just playing the devil's advocate here. It could be a
Mhm.
band-aid. It could be all for naught because 200 billion could go pretty quick when they put it into the bond market.
Yeah, and like when we talked about earlier about 1.2 trillion going into there, and it helped it helped a lot.
It did.
Um, now knowing that there's about 2.2 trillion and what would you call it, borrowed funds or kind of artificial funds or
Yeah.
bought back funds.
Yeah.
With that being in there, does that ever have to get paid off?
When you're saying, what do you mean paid off? Like from
Okay, so they put the 200 billion back in there. Does that need to get replenished in the original account?
Not from that, it won't. More than likely, no. More than likely, Fannie Mae will keep generating money, and Freddie Mac will keep generating money, and they'll just keep replenishing their. They've repaid the government probably 10 times over already, or more from when they were taken over in conservatorship. Yeah,
Oh, okay. Okay.
it's a huge number that they've already generated over since the crash. That they could have been out of conservatorship many years ago if it was just based on paying the government back plus some interest.
Okay. So getting a little further into the weeds now, wouldn't it be more advantageous to use that to pay down the national deficit, or is that something where they can't use those funds towards that?
That's a great question, but isn't our deficit something like
It's like
what was it, like
30 or 35 trillion, 40 trillion
yes.
now.
So you
It's
put 200 billion. That's like throwing a quarter, in a sea of other quarters.
Yeah, that's true. Well, I was thinking more, okay, like if they're paying the government back and they're generating 200, they've generated 200 billion, let's
Yeah.
just say, because we don't know what the numbers actually look like. 200 billion in 5 years. That's, I don't know, what is that, like 25 billion a year, 20 billion a
Yeah.
year?
No, that 200 billion is 40 billion in
40
five
billion. Okay.
years.
Yeah. That's why you're the numbers guy, not me.
Yes. Hey, I don't always get it right, but in this case, I did. Yeah,
Yeah,
I
yeah,
mean that's a lot of money, man. You know.
yeah. Okay. Yeah, it's a, I don't know. I'm thinking more from a national deficit standpoint. Like, yeah, maybe
I
there's
don't
there's something they could do.
I don't think that would make a dent in that. It just
Yeah,
no
okay, that's
way.
true. I'd rather see go to housing anyways. That's our profession.
Yeah. If they could do something that would get more housing built quicker, I think that would be beneficial as well. It's because at the end of the day, when you have a 700, let's say 700 or $600,000 house, and let's say the payment at, and I'm just going to use general numbers. Let's say the payment at 7% is 5,500 or 5,600, but at 6% it's 5,000. Okay, that's a
Okay.
five or $600 difference in payment, and those aren't exact numbers. I'm just using hypothetical numbers, but it's a $500 or $600 difference in payment. Is that really enough to still get somebody to buy a home because they're going to save 500 or 600 bucks? Because if you can't afford 5,600, or you might still not be able to afford a $5,000 payment. Yeah, and I'm talking general for our area, right? I know there's
Hmm.
areas across the country that are a lot lower than that, but realistically, in our area, you're five, six, 700,000.
Yeah, and five, 600, 5 or 600 bucks a month. That's, I mean, in purchase price, that's, almost what, 70 grand?
On a $5,000 payment would be about a $600,000 home with minimal down.
Okay. So, I mean, when you go city to city, average in Mobile, Moreno Valley is about 550, Riverside's about
Right.
650. So per 100 grand is probably what, about 800 bucks now for
About
housing
seven
price?
to 800. Yeah.
700, 800. So I mean that can, if you're looking and you're priced out of Riverside, that could absolutely bring you to Moreno Valley.
Yeah.
If you want to be in Mobile, that could absolutely get you something in San Jacinto. Not necessarily where you want to be, but it gets you in the market.
It definitely helps. I mean, I'm not saying it's not going to help because it definitely helps.
Yeah.
It's definitely going to be a boost to people who maybe just needed that little bit of extra incentive to in lower rate to get into the market.
Yeah, yeah, because I mean, we all know there's a ton of people on the sidelines that are just priced
Yeah.
out. I mean, the amount of people that apply and it's just okay, we're a little off. That kind of infusion could absolutely help them. A lot of the numbers I was seeing was it could be like $130 a month savings, where it doesn't really seem like the best use of resources.
You know, when you talk about there's a lot of people sitting on the sidelines. If you remember during the COVID years, just like we were talking, every single open house, every single property was sold within a couple of days, and there were tons and tons of people looking at these houses, and they were ready to pay over what the house was worth in cash, right? I
Oh
mean,
yeah.
bringing in extra. So sometimes 50,000, 200,000, whatever it was, when you take April of 2022, May of 2022, when the rate started tipping and going up, all of these people stepped back. Now, I was saying back then, there's a ton of people on the sidelines with these funds ready to buy, but they never fully came back into the market yet. But there were a
Mhm.
lot of those people out there that were willing to buy at that time, but didn't buy afterwards.
Yeah, yeah, there was. I mean, I think every listing, if you did a bad job listing a property, you were getting 10 offers.
Right, right.
That's doing a bad, like, just very mediocre bad job. There was a lot of people that were absolutely got left looking and waiting after that June spike of, what was it, 2022?
Yeah, 22.
Yeah, so we know, because we're in it. There's a lot of people. I still talk to people. They're like, yeah, we've been waiting since 21, or we got beat out, so we just went back to renting. We're ready to come back into the market now.
Right.
So, so that little dip in rates, I think the magic number in the business where we thought we would see a lot of those people bought during 22, 23, 21, whatever, that got into that house, had that killer rate, but the house was too small and they just bought what they could afford.
Yeah,
We thought forever 5.5% was like kind of that magic number to get them to come back into the market.
right.
From my conversations now, what I'm seeing, it looks like it's like 5.7, 5.8.
And the reason I'll give a good reason why I think that number is changing, because I agree with you. I was looking at, a lot of people were looking at that 5.5 rate, right? Like we get there, even a little bit. Initially, people were saying 6%. That's when rates were 8%. But I think what you're seeing more of is number one, what you just said. People have outgrown those homes that they really weren't in love with to begin with when they bought during COVID. Maybe there's problems with the home that they didn't anticipate, but also I think when you factor in the debt level of where a lot of people unfortunately are right now, they can look at that as a way to cash out some of the equity, pay off some debt, and kind of get a fresh start on a different home, and start over at that rate. So there's a lot of factors,
Mhm.
there's a lot of factors that definitely come into play.
Yeah, absolutely. And a lot of those folks were first time buyers, younger couples, maybe had one kid at the time, now they have two or three. That's what I'm seeing a lot. Yeah, I personally went on 3 appointments last week with people in, 2 bedroom homes or 3 bedroom homes where, now their kids are bigger, the house is a
Yeah,
lot smaller. Uh, you know, it's outgrown now. So
yeah,
they're ready to jump back into the market. The hard conversation though is, if you bought like in summer of 23 or yeah, 22, sorry, your equity is
yeah.
not going to be as high as what you were
Right,
hoping.
right,
So that's a little bit hard. Like there's still equity, but it's not enough to, do what you want with the next
right.
house. And prior to COVID, one of the cool conversations you could have with somebody if they were in their house more than 3 years or 4 years is you can sell this house, just move all the equity over, your payment's going to go up 100 or $200. Now
Right.
you're seeing that go up, quite a bit more.
Significantly. Hey, let me share with you. I pulled up something here. So 600,000. I just did some hypothetical number. 600,000 with 5% down at a 6.5% rate. Okay, which we were just there not too long ago. 6.5, right?
Hmm.
All in, I'm just estimating about 4,700. Okay, so just under 5 grand. Now, if you were to go to 5 points, let's just say we got to 5.75. Now we go to 44.17. So about a $300 savings from 6.5 to 5.75 on a five on a $600,000 home with 5% down.
Okay,
So
so how much was the monthly savings?
about $300.
$300, and that's on 3 quarters on 0.75, 3 quarters of a
Yep,
point.
from six, yes, from 6.5 to 5 point, so about a three-quarter point drop. So
Yeah.
let's just say it was a full point, you're looking at 43, about 43.27 to 47. So about $375, $370 difference.
Okay. That's, I
Yeah,
mean, that's
it's
car
helpful,
payment.
right?
That's a car
Yeah,
payment.
yeah,
That's student loans. That's a
it's
credit card
something.
payment.
Yeah, yeah. So I mean, it could definitely make a difference.
Yeah. Or even just to pull some equity out to pay some of that stuff off.
Right.
So yeah, opening up options.
Yeah, absolutely.
Okay, so now we'll go into the second part. This was the investor ban. This actually got a ton of attention. I almost called you to jump on one of these. I think it was last Tuesday he brought this up, or last Wednesday. Trump says he wants to ban large investors from buying houses. It's part of his affordability plan. Depending on who you talk to, a large investor is typically they own. I mean, I've seen anywhere as low as 50 houses. I know some people say 10. I think when you're talking about large investors, though, you got to be looking at 100 plus doors. Um, so he wants to block institutional investors from buying houses, saying that a ban would make it easier for young families to buy their first home. One thing I wanted to look at was, let me pull up my screen, because the rumor is, or kind of the word going around is that private equity investors own 20% of the homes.
Something like that. I mean, I've heard the same thing, but I don't know what the actual numbers are. I don't know if any of us know what the actual numbers are.
It's because we're depending on where you go, it's a million. You get a different answer. You ask 10 people, you'll
Yeah.
get 12 different answers. So I just kind of started Googling, looking for different resources. Do private equity firms own 20% of single family homes? Short answer, no. Large institutional investors are defined as those owning 100 doors or 100 homes or more. Really, they own 3% of the rental stock nationwide. That's according to Brookings. The share is higher in some local markets. So when you look at, like Austin or Nashville, those areas are going to be a lot higher than say like a Phoenix or probably even in LA. So in metro statistical areas, these investors are most present. They own about 12.4%. So those are going to be, the bigger, higher rental areas. So going back to this original screen, people live in homes, no, not corporations. I love that quote. So he wanted to roll out some of the most aggressive housing reforms, and he did campaign on making housing more affordable. I don't think we really saw any plans until, maybe month 2 or 3 of what he was doing. I honestly don't have a problem with him banning the larger firms from doing stuff like that. I know during the COVID years, a lot of investors were coming in, and I don't really want to say the name of the one I kept running into. They were overbidding in certain areas. They would go through, buy 3 or 4 properties. I don't know if you saw this, John, or more. So they buy them at market value, then they go into a couple lucky homeowners and offer them 40, 50,000 over market.
Mhm.
And the reason they would do that is so that they could use their own comps as the comparables when they went to buy these other ones. So
Right.
if your market says, or your neighborhood or general vicinity says your house is worth 400,000, they were buying up a handful of them at 450,000 and setting their own comps. They would buy them cash so they wouldn't have to do an appraisal on it. I'm not saying that's why the housing market is screwed up the way it is, but I'm not saying it's not.
That's a good way to say it.
Yeah, I actually worked with one of those investors after the fact, and I did not like the way they did business, so I chose not to anymore. Um, I don't want to say their name because
Yeah, I
they
got you.
got deep pockets, deep pockets.
Yep.
Um, so how do you feel about this one? I think it's a good thing. I don't think it's going to fix anything, but I don't think it hurts.
So I agree with you. But I will say that for some reason, it's out there that these big corporations, these hedge funds, are purchasing just all of the houses on the market, which is just it's not true. First
Hmm.
of all, okay, and this may sound a little maybe not right or whatever, but I'm going to say it. I think if you were to stop more of the foreign buyers coming into the U.S. as a whole and buying properties, I think you would have much more of an impact there. And I'm talking about people that don't live in the U.S., right?
Hmm.
And I'm not saying that it's right. They're taking advantage of what we have in the United States in a good way that helps them. But I
Yeah.
think that's more of, I think that would have more of an impact than banning these buyers.
Yeah, actually, I'm gonna look up the stats on that one. I've heard that. I've never really looked into foreign investors, because you always hear the conspiracies. China's buying up massive amounts of acres in whatever it is, Utah or Michigan.
Right. All over.
Yeah,
I mean, some are true, some stuff's true, some's not. But
yeah.
but there, but that is, and I believe Florida actually banned foreign investors from purchasing in Florida 1 or 2 years ago. I don't know if any other states have followed suit, but Florida did that.
So that's actually a good point. I'm looking up the stats now. It looks like about 1.8 to 2% of all existing home sales is foreign investors.
Compared to about, what did you say
Like
it was on
3%
the?
of a large equity.
Okay, so it's about, see, again, I didn't do the numbers, but
Mhm.
I think I think they both have an impact, but I find it hard to believe that it's only about 1.8 to 2%. Because that, I mean, I'm not saying the information's wrong. I'm just saying, for me,
Hmm.
taking that in, I think it's I thought it was much more than that. So maybe I was speaking out of turn there, but
Yeah,
that
maybe.
they
Yeah,
there is
1.8 to 2%. 2025 is estimated to be about 2.5%.
so continuing to increase.
Hmm.
Yeah.
Yeah,
Okay.
actually, good point.
So even when you look at the numbers for both of those, it's still pretty insignificant, right? I mean, you're talking 3-4% total,
Yeah, yeah,
across
we just laid out about 5%.
5% total. I
Yeah.
mean, even that's not somebody coming in and buying 40% of the properties. When my son was looking for a home in Rancho Cucamonga, it's going to be 3 years now. He bought like in February of 23. One of the houses he lost out on was because one of those big companies was purchasing in the neighborhood. And of course, they came in all cash and everything, and paid
Mhm.
over asking. This was in 2023. So he did lose out on something, but he found another property, which is fine. But at the time, even then, it wasn't a lot. It was just random, right? You didn't know who was bidding up against you, but some of them were corporations.
Yeah, during that time, there was no way to know either. I mean, even on the listing side, we could barely keep track of what was coming in.
Yeah,
I mean, houses, if it was popular, it was getting like 70 offers. Like,
right.
that's
Yeah,
not even exaggerating. I think my highest one was 68, and just keeping track of what's
yeah,
what, who can do what. It's just you basically just have to kind of eliminate half.
yep,
Like, you have to have that threshold. Um, so I think one of the big things with investors, though, that people just don't realize is technically an investor is somebody that you know buys a property for a profit, or rents it out or sells it at a profit. By far and away, the majority of those are going to be mom and pop that own two or three properties.
right,
So going into that, the speculation in the business or around the market is, once that older generation starts selling off those properties, because most of them are boomers or Gen Xers, that they started in that two-bedroom, one bath, they were able to
yeah,
keep it, buy the next one, and so on and so forth. So now they have a portfolio of about 5 or 6 homes. Once those start going up, because a lot of those are obviously rentals, that could free up a lot of inventory.
right. I mean, you're seeing a lot of that boomer generation, and maybe I forget, I think they call it the greatest generation, the one before them, before the ones that had the boomers. Those guys are in their 90s and high 90s now, but even the boomers, you're seeing a lot of. I know I'm seeing. I know I've talked to you about this. I'm seeing a lot of the transactions that I'm doing are trust sales from boomers that have, you say boomers, older people that have passed away, and now their heirs are selling the properties. I mean, you're starting to see more and more of that now, um, and I think we're going to continue to see that as the population ages out, and whether passes away or has to move in with family or whatever it may be. I was talking to a friend today. It's the same thing with him, and two people actually today. The mom is 80, and she's struggling. The mom has dementia, so they're thinking we're gonna have to sell her home pretty soon. She's 80 years old, right? She can't. I mean, they have care for her. Another one, the mom is 86, and it's the same thing. So you're starting to see that more and more, and there
Mhm.
will be more inventory on that. I mean, you hate to see it like that, but that's just the evolution of time of what happens.
Yeah, and a lot of, I mean, not a lot, but a good portion of my listings, or a lot of folks I've been dealing with the last couple years, are it's that trust or conservatorship that ultimately just decide to sell that home. And I'm seeing that a lot in the listings now. It's those trust probate listings are those are on the rise big time.
Right.
Before it was kind of here and there. Now it's pretty regular. You're seeing those sales. I know we're getting kind of into a darker, more grim side of this. But the reality of the market is, once that inventory starts to free up, then you have more homes for first time buyers because a lot of those homes are first time buyer type homes. 2 bedroom, one bath, 3 bed, one
Right.
bath. From a rental perspective, those are a lot easier to keep and maintain, and cheaper and easier to rent out just because the costs are a lot lower on those.
Right.
But as those come up, those are great first time buyer homes, are great options. I know personally, my first home was a 2 bedroom, one bath. I didn't stay there very long. I wish I would have hung on to it. We've talked about that in the past. But I mean, maintenance on the thing was dirt cheap.
Yeah.
If I would have hung on to it, that would have been a great rental.
Yep. They're definitely great rentals, the two
Mhm.
bedroom, one bath. I have one of those in Paris, and I've had it since 2013, and got that for purchased it for less than 100,000. Back in 2013.
Yeah, damn.
Yes.
Yeah, we won't see that again for a while.
No, not in California.
Yeah. So okay, that kind of wraps up what we wanted to cover today. Um, Now with these two things, with the investors, I don't expect that to make really any sort of significant dent in the market, just because there's such a small percentage of actual
Right.
buyers. If you break it down by quarter, some quarters they'll be a lot higher than what do we say about the 3 to 5%. I think in the peak of things, there was a quarter there in 2022 where there were about 25% of the buyers.
Right.
But
It was all condensed into one quarter.
yeah, yeah, that's one quarter. But when you average out over the year, like what were they doing the rest of the year? If they're
Right.
about 3% of the actual sales,
Right.
you know. So, but the $200 billion thing, I think, is really the most interesting. With the actual money going back in, it's interesting. It could make a dent, but I think where it gets more momentum in the housing market is it just gets people excited and off the sidelines. Because
Yeah.
like we talked about, a lot of people have been watching for a long time now, just kind of waiting for that correction. And, from where we're sitting and what we're looking at in any indicators, it just doesn't seem like that correction's coming as soon as what people would want.
I don't think so either. Um, because, like I said before, I think it boils down really more than rate. It boils down to house price, right? The if for housing to be super affordable, for what I mean, and who even says where that number is? Affordable housing, right? Like who
Mhm.
knows what that is? But we would have to have a significant decline in home prices, I think, for housing to be really affordable for people, um, based on what they're trying to do. Because even if we get down to 5%, 5.5%, like I showed you here, a 1% drop is, what did we say, $370. It's a good amount. Don't get me wrong, but it's the payment is still a significant payment,
Mhm.
for people. And for those, I think the key is, like we talked about before, is just preparing. If you think you can afford a payment in that range, you should move forward with buying a house. Not because I want to do a loan or you want to sell somebody a house, more because it's if you're able to go ahead and get into a home, you have something that's yours, and you ride it out. If it's 10 years, the market goes up, the market comes down a little, the market goes up. At least you're riding it out and you're still gaining along the way. At the end of the day, you're going to gain. It's and again, like you said, it's not going to happen in 1 or 2 years. Buying a home is a long-term play. It's not buy it, make 100,000 and sell the next year. That's not realistic.
No. No, there's been a couple times, like couple like 6 month increments in history where that was probably a reality, but
Yeah.
there was no way to know that was going to happen. There was no way. Unless you're an investor or you're flipping a home. But if you're buying a house to live in, primary residence, you're not going to get that $100,000 appreciation. And okay, the way to do it is, they call it the sweat equity way, by the ugliest house in the nicest neighborhood.
Yep.
Put the love and care into it that would, you know, get that money back. That's really the formula for it. That's
Right.
not the sexy answer. That's not the exciting answer. But just moving into a home and just kind of riding it out for a year or two, you're going to
Mhm.
see appreciation, but not an insane amount.
Right. And I mean, you got to figure, for if you buy a $500,000 home, to gain $100,000, you need 20%. You need your property to go up 20%, right?
Mhm.
You know, to get to that point. Now, with historical numbers at 3 to 4%, between 3 and 4 to 3 to 5% is historical appreciation. That creates a healthy market long term. If you're gaining 3, 4, 5%, that's a healthy market. If we get into those periods where we were in COVID, when you're gaining 20% year over year, number one, it's unsustainable. Number two, that's just not good. It's not good, and it's not healthy for the overall market. It's good for sellers, but it's not good for buyers or the overall market, because when you fast forward 3 years, 4 years, 5 years, and here we are. we're
Yeah.
we're stuck, right? I mean, like with these super low rates, and higher prices. Again, I don't think any of that is negative. I just think that's where we are, and that's what we deal with in this present time.
Yeah. And something else I kind of wanted to talk about, but I totally slipped my mind. With these things that Trump is proposing doing, the $200 billion going back in and the ban on investors, do you think this is meddling too much in the market to try and manipulate or fix it? Or do you think we're better off just letting the market write itself out and course correct on its own?
So I'm one of those guys that even when 2008 happened, and I'm a believer, you let it play out, right? And because if you keep interfering, and it wasn't just this administration, it's been every administration, right? If
Hmm.
you keep interfering with what's happening, you're going to always have these problems over and over, where you're going to have to keep interfering. So I think at some point you have to let things play out. And I mean, if you go back to 2008, and it was a horrible time, don't get me wrong. I'm not somebody that says throw people out on the street, but people lived in their homes for 3, 4, 5 years and didn't make mortgage payments, right? I mean, there was a lot of that. The banks didn't want to get them out. They did a lot of modifications. The percentage of modifications that get out of modification and go back into modification is very, very high. Again, I don't have the numbers, but I want to say it's probably 40 to 60% from
Oh,
from
wow.
what I've heard. So they're band-aids, right? So I think at some point you have to let things play out, and I mean, obviously you can't let the whole economy collapse, but there are things you have to do to let it play out. I mean, and so that's kind of been my thought since I was there during the '08 years of doing mortgages, and saw that and lived through it. I think there was a lot of interference there. Then when you get to COVID, um, the interference with the low rates, which messed everything up for today, because now
Mhm.
people think that these rates are astronomical. And if the rates hadn't have been that low during COVID, the homes probably wouldn't have went up that high as much as they did. It fully accelerated that. So I do think it has its place, but I also think that it could have a bad effect, and we're seeing that.
Yeah, and I completely agree with during COVID. Like even during COVID, I was saying these rates are whatever they're doing, they need to stop. It was too much. It was too much too long. I
Yeah,
understood it at first. The world was in a weird place. Nobody knew what was going on, and the government solution to that is always to keep people happy and tell them to spend their money. And I sound like a freaking conspiracy theorist. They did a good job with at getting us to do that. And
yeah,
having those rates that low was a really good strategy for that. Of course, now we're in this pickle now, but that absolutely filled fire to this. I think the market would have, if they would have left rates, where were they during that time, like before COVID, like 4.5, 5%.
man, that's a great question. I would have to go back and look, because I really don't remember. Coming out of 2019, I really don't remember where we were
I
in the
remember
financial.
2019, January 2019, they were creeping up to about 5.5%. Reason I remember that is because I had a few listings sitting and people were really, buyers would come through and they didn't like the rates. During that time, Trump was in office. He put pressure on the Fed, and they actually did lower rates during that time, and the market kind of picked up again. And
Right.
I think that's why a lot of investors during that time they thought that was the peak of the housing market. I think with COVID happening, that's a whole nother type of podcast if we're going to talk about COVID not happening. But with COVID happening, I think homes were going to go up anyways because people were in their homes. We were locked down. So any of those glaring issues in your house, or living with in-laws or in your apartment, people all of a sudden had motivation to go buy a home again. Prior to that, people were working. If you lived with your
Yeah,
folks, they're at work, you're at work, you weren't crossing paths nonstop. Now all of a sudden you're shut in. Like, okay, get me the hell out of here, right?
yeah.
So I think housing would have popped either way. I don't think it would have popped as much. If rates would have stayed the same, even if they were at 3.5 for, let's say, a year. But I don't think government meddling, like right now, I don't think it's the proper time for it. Like, I don't think it's a bad time, but I don't think it's necessary right now. Yeah, housing is unaffordable. This is I see it personally as a temporary band-aid. I don't know what's on the other side of it. It could be a good thing. I hope it is. I'm always trying to look through an optimistic lens at this. But I think it's something to stimulate spending again, or stimulate, people going into the market, because there is so much depression, from the outside looking in, or on the housing market.
Right.
But I don't think it moves the needle enough, for first time buyers, for people looking to refi that haven't been able to for the last 3 or 4 years. For some folks it is, but overall, I don't think it's great for everybody.
And we're kind of on the same page there, because I think there has to be a bigger, there has to be more, something different has to happen for people to really get excited about buying. Because I mean, like I said before, if your mortgage payment is $5,000, you have to make, let's just say, $15,000 a month to be able to do that, to be healthy with make your payment, have some other bills. You're talking $180,000 a year to get into a $5,000 payment. I mean, you could get in with less if you don't have any debt, or it could be
Mhm.
10, 12,000. But let's just use a conservative number, or 15 grand. And I think that's, if you can't do that at a $5,600 payment, you're not going to be able to do that at a $5,300 payment, I guess, is my point.
Yeah.
You see that's more what I'm saying. If you can't afford 5,000 already, this is not going to even affect you.
Yeah, and the number I keep seeing is to be middle class now. It used to be what, like 80 grand. I think in California it's like 140
Yeah,
is like,
it's gone way up.
it's like barely middle class now.
Yeah,
And that's a huge number. I mean, if you're working like a regular, like 9 to 5 job, it's like 70 grand an hour, or sorry, $70 an hour to get to like 140 grand.
yeah,
I
yeah.
mean, not a lot of school teachers are making that.
No, I remember probably 2018, 19, before COVID. Um, you could have made 70,000, $80,000 a year, and I'm talking about in Moreno Valley, or area, Moreno Valley, Paris, and bought a house at that time.
Mm.
But when you see how quickly how much money you need, how quick it took to get there, it's been a huge jump since that time.
Yeah.
You know?
Yeah, and I guess counterpoint to what I was saying earlier is, if you're going in, you're looking at, what do we say, a $600,000 house, you're about
Yeah,
like 5 grand
yeah,
a month
for about
roughly,
4,700.
4,700. If I'm a consumer, if I'm a buyer and I'm looking and I see, 5,500 versus 5,000, 5,000 seems a lot more palatable if I can afford 5,500.
And that's the thing. If you can afford the 5,500, you're just not willing to do it. So
Mm.
5,000 sounds better. But if you're out of that category of being able to afford it anyway, it's a moot point.
Yeah.
I mean, even getting a rate down to 4% probably isn't going to change that. For somebody.
Yeah, so I mean, I guess to sum it all up, the amount of people that this helps is pretty minuscule in the scheme of things.
It will help people. I think it will help. Like, I think what you just described it, the person that might have been looking at a $5,500 payment and is now looking at 5,000. I think that's more. And you could use that in any numbers, whether it's 45 to 4 or whatever. but I think that's more where it'll help those people that are already. I think people that are close, it may help them get off the fence.
Yeah, and that's that's always a good thing, but I mean, this isn't for sure yet, right? This is
Right.
just kind of
Yeah,
a
still not for sure.
more talking points.
Yeah, yeah. Like hey, I talked to a guy today. I had a sit down with some people that were that want to purchase a home, and it was a dad and two sons. And the dad asked me today, he's like, "What do you think about the 50-year mortgage?" Because I would do that. I'm like, dude, that came and went so fast.
Yeah. Is
You
that
know,
completely off the table now? I only see people like reference that they're just kind of like, "Oh, if this passes." I don't see anybody in our space talking about it.
I I don't think that was. I think it was just a quick blurb. I don't think that was ever anything that would ever come to pass because it just I, I don't think it would be a very useful product.
Yeah.
In looking at the numbers.
Yeah,
And
there would have to be a massive restructure on for that product on its own.
yeah,
When you compare it to a 30-year, because
yeah,
even going like we talked about this to death, but even going 15 to 30 year, it's a huge jump in payment,
yeah,
but it's not for everybody.
yeah, and I mean, yeah, I just thought it was funny because I hadn't heard anybody talk to me about it recently, and he's like, dude, I would totally do the 50-year, and even his kids were telling him, 24 and a 22-year-old saying, Dad, we did the numbers. Those numbers would not make sense for us, even if it
Yeah.
was out, and but hey, it is what it is.
What about the rate you can take with you? I haven't heard that in a while either.
Yeah, that again, that's another one of those things. I think there would need to be some. I Man, I hate to sound so pessimistic because I'm not a pessimistic guy, but I just think that there would be so much work that needs to be done to be able to do that.
Mhm.
I mean, I think the infrastructure to handle that would be off the charts, and it would be very difficult to implement. You know?
Yeah, yeah, and I think we talked about it on another
Yeah,
one of these where it's how do you comp properties, when you have people at, 4.5%, somebody at 2.75, somebody at 7%, like
yeah,
it would really, it's like a bunch of cash investors coming into the market.
yeah.
Like, but so these are the primaries, so they're not just like renting them out, but it's this person's buying power at this price point is way more than
Right,
somebody else
right.
at the same.
So yeah, that's just another one of those things, man. I mean, these are all great talking points
Mhm.
that they're bringing up, right? But at the end of the day, which of these are going to be implemented, and what's really going to be real world for people?
Yeah. Yeah, and I guess diving into these, it just shows us that, with how crazy things have gotten the last, how crazy they got,
Yeah,
and kind of what we're dealing with now, with the unaffordability issue, the rates being, quote unquote high, but really just kind of historically average. There's
right,
some sort of reform that needs to happen or some sort of shift in the housing market that really needs to take place, before like any because these are all just kind of band-aids. They're
right.
little temporary fixes that they're not enough to really move the needle for, America as a whole. For some folks it's a little bit, and a little bit can go a long way, but
Right.
like my kids, just they're young, but they'll be home buying age in about 15 years. Where's housing going to be at then? Like if these things do affect housing to where you make things more affordable, naturally pricing is going to go up. If you're not if pricing is not going to come down, so you're going to find a way to make it more affordable, pricing is just going to keep going up. So you're just kind of chasing the ball uphill, to use a really bad
Yeah,
analogy. So, in 10, 15 years from now, what does the housing market look like if something actually tangible doesn't happen, or something that actually makes sense doesn't happen?
yeah. It's. I mean, and again, I've been in the business for 25 years, and in my 25 years, the worst I saw was '08, right? And haven't really seen, excuse me, and it was around till late 2010, 2011, early 11, when the bottom, I think the bottom was late 10, early 11. And since then, we have not really seen, I mean, you mentioned, I think 2018 and 19 when you thought we were going to have a crash or something to that. But take that out. Even then, we have not seen prices come down, dramatically since 2010.
Hmm.
Since people started buying again at the end of 10, beginning of 11, when we were at rock bottom,
Yeah.
and I mean, I I let's see, 2010. I think I mentioned this before. I bought a property for $60,000 in 2010, and sold it for about 400,000 in 2023, at the end of 23. So 13 years, it went from 60 to 400, right? And I just don't. We just have not seen any huge drops in prices. It's just gone up. It might have dipped or plateaued a little bit, but then it went back up, right?
Yeah.
And then the boost that we had with COVID just skyrocketed the values. Um, so yeah, I just don't. I mean, I think another, and we talked about this. I did a video, probably last year, from 2008, when all of the homes were being sold at that time, to now. I think our population growth has grown over 40 million people, and housing has not kept up.
Yeah.
I mean, so when you talk about how far behind we are on housing, I mean, when your population is growing at that pace and housing is not, where do people go? You know?
Yeah.
I mean,
Yeah.
that
Multi-gen living, or they leave the
yeah,
state.
right. But I mean, those are real challenges, you know. But
Yeah, absolutely.
overall, I do think this is a prime time for you to buy a home, if it fits your budget. If it fits your budget, you should not worry about rate. You should not worry about the home price. But if it fits you personally, you should purchase a home, because it's always going to get better, you know.
Yeah, absolutely. I mean, there's only been a few, I mean, what, five or six like big dips in recorded history. I mean, recording history going back to like the 40s, but a few big dips. I mean, the most recent one was 2022, and that was like a 5% dip. Nobody even noticed it. It was so
That
small.
was
I mean,
because we were in a
people
major
selling did,
correction.
but
It was a
yeah,
major correction coming out of 2% and 3% rates.
yeah, yeah, and it was bound to happen. And but it wasn't the correction that, I mean, obviously needed to happen, but it wasn't the one people were looking for. And it was so quick. It was just,
Yeah.
I mean, it was like a 5 month thing, and it was just boom, right back.
Rates shot up 5% that year, the
Yeah,
fastest that rates had ever gone up at any other point in history
yeah,
since they've
it
been
was wild.
recording it. You know, that was, when we got to 8%, we all just looked around like, what the heck just happened?
Yeah,
you,
I
you
remember
know,
that. I
yeah,
I remember being in the office, just like, we're talking, and it looked like they were going to go to 10%, during
yeah,
that
it's
time. I'm
crazy.
just like, geez, what do we do? I mean, luckily they
And
didn't.
where prices were, right? Because we were peaked out on prices at that point, on
Hmm.
home prices.
Yeah.
So, I mean, to see those kind of rates, and I think I might have told you this. I had a client that was buying in Irvine at that time. The house was listed, I think, 1.1 million, and they listed it in April of 22. My clients bought it in June of 22, and I think they got it for like 900,000. The sellers literally missed the market by a couple of months.
Oh, wow.
I had a house around the block from me. They tried to sell their house, put it for sale in April of 22 for 750. The house next door, model match, sold for 650, and they thought they were going to sell for 750.
Oof.
And,
Oh,
and
that's a hard conversation.
yeah, and the house never sold, right? I kid you not, Justin. It's gone up for sale a few times, and it literally just sold a few months ago. I
Oh,
don't even know
really?
what the price was, but it was
Yeah.
not. I don't think it was even 650.
Oh,
You,
that's
you know?
rough. That sucks to know you were right there. You just missed
Yeah,
it.
right there. You missed
Yeah,
it, but
during
you can't time it.
22, I had a listing, a buyer. They had a little two-bedroom, one-bath house, and this is in April of 22. And this is what rates were creeping up, and we knew they were going up. They were doing like the move up thing, the little two-bedroom house into like the five-bedroom. We put their house on the market, and it was like one of the last ones to sell, where it was like 40, 50 offers. the house they got was a second, it was one of those move up homes, so they were sitting longer at that time because rates were I think 5% from three. So they timed the market perfectly, like literally, like they sold their
Yeah.
house way. It was like 40 or 50 grand over asking. They got the house they wanted. It was one of the move up ones. They hadn't started doing price reductions yet, so they got it for like I think 30 grand under market and closing costs covered. And
Yep.
I remember thinking like, what the hell happened?
Yep.
Like, there's no way this worked. But it was, that was 100% indication of the times we were going to at that time.
And just coming out of the craziness of COVID, right? How
Yeah,
quickly, you never know how fast the markets can change and shift until it's right in front of you.
yeah.
And because it happens like that, man.
Yeah, yeah, that was the wildest one where I was like, geez, because
Yeah.
I was watching both sides, because we're always watching, like, okay, like what's this neighborhood doing versus this neighborhood. The starter neighborhoods were still going quick. The move up ones were,
Right.
they were starting to sit those like 25 days, which was insane at that time.
Right.
So,
Right.
sellers were starting to panic on that side, and we literally she timed it perfect on both. Yeah, the
Yep.
buyer seller timed it perfect on both sides, and it was that's still like one of my favorite real estate stories. I'm just like, geez, it was two completely different markets for the exact same client.
Yeah. And it all happened back to back.
Oh, it was
You,
crazy. Yeah, it was like literally
yeah.
going. It was simultaneous. It
Yeah.
was
Which
wild.
is so crazy. I mean,
Yeah,
that's real estate for you.
yeah. It
You just
was
never
it was
know.
cool. I mean, like luckily, like I'm as involved in the market as I am because if I
Yeah.
wasn't paying attention, it'd be like, yeah, just wait for market rates to get better.
Which is what everybody's saying right now. Wait for rates to
Yeah,
get better. Wait for the market to crash. Wait for prices to be better. Okay.
yeah, yeah.
Tell that to the guy that's been waiting for 10 years.
I got to call a few of those tomorrow.
Yeah.
So,
Well,
hey,
good
well, I
stuff
guess that's a good
today.
place to end it. We're at about a
Yeah.
little over an hour now.
Yeah,
Um,
good stuff, man.
yeah, no, this is a good one. I feel like we went pretty deep on it in depth. If anybody watching has any questions or wants further explanation or just wants to chat about it, contact information is below there. You can reach out to myself or John. But anyways, thank you guys for watching. We'll have another video coming up Thursday, and our next live will be next Monday. So don't forget to subscribe. Anyways, thank you guys for watching. See you around.